Hey guys, welcome to this new video. This video is going to be about the US economy and how is the macroeconomic situation in US. I had made a video earlier as well in the month of September talking about how the US economy is doing. And I thought this is a good time before the next Fed FOMC meeting on 22nd of March. It is good that we analyze the various indicators of the macroeconomic situation in US, and then we could jump on to a conclusion that how could we see the economy from here. So right now we are in March 2023, and let's go and discuss the US economic data. So if you look at this presentation which I've made, so the learning outcomes from this presentation will be that we will know how the economic situation is right now, what are the various indicators I personally use to gauge how the economy is doing, and then we will look at what kind of cycle are we in the US and what is the expectation from the Fed FOMC of March, which is another 5 days away from here. So it is really important how the market is expecting, because some changes in the economy have happened in the past few days. If you must have seen, there was first the Silicon Valley Bank that collapsed, then there was news with Signature Bank, then First Republic Bank, then Credit Suisse. So there is some volatility in the market due to the fear that this might lead to a contagion risk, and the bigger risk can be at play here, and people are fearful because of what had happened in 2008 in US, and then people are thinking, the market is thinking that this could be the start of something big. So there is some jitteriness in the economy, and because of all of this, the markets are also volatile, and the next Fed FOMC, people really don't know what is going to happen. A lot of changes have happened in the past 1-2 weeks regarding the next expectation for the next Fed FOMC. So we will discuss that as well. Now, first, let's discuss what is the inflation in US. So February, if you see, currently we are in Feb, and in Feb, the Fed FOMC meeting, before the Fed FOMC meeting, the most important data which everyone was looking at was the February CPI data in US, and it came at 6%, and the previous one in January was 6.4. So previous one was 6.4, and this month is at 6. And if you see, since June 2022, the trend has been that we might be heading lower, and we have shown that inflation has peaked over the months. And this gives us weight that whatever the Fed is doing with interest rate hikes, that is proving to be beneficial for the economy. Inflation is coming in control, but Fed's tolerance level, the tolerance level for Fed is 2% inflation. That's when they say that there is price stability, and their main aim is this, that they want to get the price stability in the market. So 2% is their level, 6% is the current inflation. So we can expect 2% to happen by next year. Before that, the predictions don't say that we are coming under 2%. And what had happened in the December CPI data and then in the January data, there was a fear in the market because both these data points came above expectation. But what has happened positive is that this time we were expecting 6%, and the market was expecting 6%, and we got 6%. So that is a positive sign. Now, after this, we will go and we will look at the next data point. So the next data point is the growth. So the growth, if you see, is still positive. After 2 negative quarters of growth, now we have 2 positive quarters of growth. So that is why the whole scenario and the whole talk around recession is still not happening that much, because people are expecting that growth is still there in the economy. Until that time, we don't have to say that recession is here, and we can expect that the Fed is going for a soft landing. But over the past few days, a lot of things have happened in the US banks and in the European bank Credit Suisse. So now the recession talk has started to happen again. But if you see the last 2 quarters, the growth was positive. So that is a good sign, like Fed is increasing the interest rates, inflation is also coming down, but your growth is also still there. So that is good. And in UK as well, if you see UK as well, the growth was higher than expected, and that is why now the talk is that in 2023, the UK people are also saying, the UK banks and the UK Treasury is also saying that we might not go into recession this year. So this was the second data which I wanted to talk to you about. And then now the next one is the unemployment rate. The most the data points, the job market data points we look at is unemployment rate, and mainly the second one we look at is the payroll data, non-farm payroll. So if you look at the unemployment data, February 3.6%. This just came out a week before, and this was at 3.6%. Previous was at 3.4. The good part about this time's job data is that expectation was 3.4 unemployment rate, but it came at 3.6, and Fed wants that this unemployment rate should go higher, because the major issue for Fed and the major issue for them in their fight against inflation is the job markets right now. Job market is still strong, and that's what Fed doesn't want. So Fed is saying that we want to kill this job market, and they want this unemployment rate to go higher. But still, the data was signaling that unemployment is coming higher than expected, lower than expected. So that means that the job market is still strong. But this time, the positive part for the stock market in this time's data was that the unemployment rate was higher than expected. So this was one positive, and the second positive was the wage growth, if you see, was lower. So the average weekly wage growth was lower, meaning that people will have less money to spend, so they will spend less. That would add lower pressure to the inflation, and this will be beneficial for the Fed's fight against inflation. So another part which was good in this time's inflation data, job markets data, was the average wage. So that was good. The wage growth was not as high as expected. So that was good for the fight against inflation. Now the second part which you have to look at is the non-farm payroll. This wasn't good in this time's data. So the major one was January. January, the expectation was somewhere around 250K, and this came at 504K. So that was like more than double. And then you started to hear those hawkish talks by Fed Chairman Powell in the month of February. They started to say that the job market is still strong, and there are issues that job market is strong, and our fight against inflation is not over yet. So we have to see how the job market is doing before we jump to a conclusion that do we have to raise rate at this pace or not. But then next data also, so the expectation was 205, so 205,000. Previous was 504, and this was 311, so 311. So it was higher than expected. So what had happened was that if this is higher than expected, then this is not good, because this is signaling that the job market is stronger than expected. But the good part is that this 504, it came down to 311. So we need to see a few more months. If this keeps coming down like the inflation, then we will start saying that the number of people that are employed in the non-farm sector the jobs. So this indicates that the people who are employed mostly in the private sector, and if this keeps coming down, then that means that lesser people are employed in the private sector. And if your unemployment rate also starts going up, the trajectory starts going up, and non-farm payroll trajectory starts coming down, then that means that inflation is also hitting the job market, which is getting weaker. And that's what Fed wants, because they want to fight inflation. And the most important part right now for them, for months, not just right now, for months, it has been the job market is still strong. So there are signs we are starting to get that the job market is also starting to crack, and it is starting to get weak. So this is the job market data which I look at, and this is starting to signal that there is a likely chance that the job market could be getting weak from here. So now after this, we will look at another important data which also gauges how the retail sector is doing and how good is the demand in the economy. So for this, we look at the US retail sales, and this we will look month on month. So we will look month on month from 1 month to the next. So in February, the month on month was -0.4. So this shows that there was a contraction in retail sales, and previous was 3.2. So in January, there was a growth of 3.2% from the previous month, and estimate was that it will be -0.3. So if you see, there was a higher contraction. So there was a bigger contraction than expected. So that means that the retail sector is also getting hit by the interest rates that Fed is hiking. People have less money to spend on the discretionary products, and people have lower savings because they are now firstly, they are fearful that they might lose their jobs, and secondly, the inflation is hitting them, and then they are thinking that we will only spend our money on the important stuff, and for that reason your retail sales are coming down. This data, if I see 3.2% expansion, this could be because of seasonality, because this came after a holiday season. So December people spend a lot, and they spend a lot in the holiday season. So this could have been because of that reason that we've seen a 3.2% increase. So clearly, when I look at the retail sales month-on-month data, negative, negative, negative. So that means that the retail sector is also getting hit by the Federal Reserve's fight against inflation and how they are rising the interest rates. People have lower money now to spend in the economy, and now they are not spending a lot. So this retail sales is also important to look at to gauge how is the consumer in the economy. Now, the next data which I look at is the US dollar. If I talk about US dollar, is very important to look at. After the war had started last year, we saw that US dollar was seen as a safe haven, also because the bond yields were also going higher. So a lot of the appeal of US dollar was also going up. So we saw dollar coming close to 114 levels, but then crude oil also fell. In the past few months, we've seen crude oil also dip, and we also saw US dollar coming down. So now what is important for me is that once we see that the bond yields have started topping out and we see that the bond yields have started to come down, I think with that there will be a risk that US dollar will also start coming down. So if 106 levels or 105.5 to 106 aren't breached on the upside, then I think there is a likely chance that we might be seeing dollar coming towards the lower levels. So for that, when that happens, we could see other emerging markets, money coming into those emerging markets eventually. But for now, there is a bigger risk of recessions. I think this won't happen till the end of year or the second half or later in the later months of this year 2023. But right now there is a bigger risk. So we will see volatility in the market. Now, the next thing which I look at is the 30-year mortgage rate. This helps me gauge how the housing market is doing, and why I look at housing market is because if you see housing in inflation, when we calculate inflation, housing has a weightage of around 44% to calculate inflation. We have 44% to the rentals and to the housing sector. So it is very important to look at how the housing market is doing, because it plays a bigger role in the calculation of the inflation. So to get a better idea about how things are going to be from here, it is very important to gauge how the US housing sector is doing. And in the last FOMC, we saw Chair Powell talking about in his press conference. He talked about that rental is one thing which we think that it could be a problem for us in the coming months. So we need to keep an eye on the rentals, and that could be the place from where we could get that sticky inflation. So he talked about that. So it is very important to keep an eye on how the housing sector is doing. So if you look at currently, the US mortgage 30-year mortgage rate is around 6.73, and in January we saw this coming down, and this coming down, it had started to stabilize, and then after that we saw it going higher, and now it is on the higher side. In March it is at 6.73. And why is this happening? Because mortgage rates tend to go up whenever there is fear that the Fed is also going to increase the interest rates. So with the interest rates, the mortgage rates also go up. So whenever Fed gets hawkish, you would see that the mortgage rates would go up, because whenever Fed gets hawkish, Chair Powell in one of the testimonies earlier in March, when he was talking about being too hawkish in his speech, so at that point the market said that Fed is going to raise interest rates, and there is a likely chance that the fight against inflation is still not over, and Fed will keep hiking rates, and the terminal rate which is currently around 5%, which is the expectation. At that point, they started to think that it would be higher towards, some brokers started to talk about 5.5% for 5.75% terminal rate. So because of that, then we saw that the mortgage rate started to go up. And if the mortgage rate goes up, the demand for housing comes down, because if you logically see, you would prefer going for a mortgage rate at 2%, but at 6.73%, you won't prefer buying a house at 6.73% mortgage rate. So you would delay your buying, and the demand of houses due to this will come down. So if mortgage rates are going up, then eventually you could see that the housing demand would come down. So for that, let's go and see the building permits. So in February, the building permits came at 1.524 million, 1.524 million, and the previous was 1.339 million, and estimate in February was 1.34. So this came in higher than expected. So that means the demand was higher than expected for building permits. So this shows that how many permits were giving for building houses. So if you see 1.524 higher than expected. So what Chair Powell was talking about in his last press conference, that the inflation from the housing demand could be sticky, and the rentals could be sticky, that is visible here, and this could be a problem. So housing could be a problem. Keep an eye on that. If this keeps rising, then this could add to inflation. And if this doesn't come in control, then your fight against inflation, the Fed's fight against inflation, is at risk, and the rates could keep going higher. So we want that the housing market shouldn't rebound from here this fast. The way the trajectory was there, that it was coming down, the building permits were coming down, this is good. But then now in February, when we saw that it came in higher, we want this to not be a permanent phenomenon, and we want this to be at the lower end only. So keep an eye on the building permits part, because this could have a big weightage on the inflation that is calculated. Now after this, I will look at the interest rates. So interest rates, February 25 basis point rate hike. So the 25 basis point is 0.25%. Before that, we had at 4.5%. Now it is at 4.75. And these were the levels we were in 2008. So we are close to around those levels. And for now, it is very important to see what the projections are in the market. And now I will show you what are the projections and predictions from the market participants and the expectation of what will happen in the next Fed FOMC. So in March, the market is expecting, let me show you this. So if you look at this, in February, this is 0, and this second box says 0.25, and the lower box says 0.5. So if you see no change, 1 week back was 0% chance. Okay, there was no talk that this time there is a likely chance that there will be no change. Then 0.25% 1 week back was 59%, close to 60% 1 week back. And 0.5% was 40%. And 0.5 got more weightage eventually because of the hawkish talks which Fed Powell did in the testimony earlier this month. Now, then we had the SVB, then we had all the regional banks crashing in the US market, and then came the Credit Suisse issue. So then people started to talk about that Fed should hold on, and there is a likely chance that Fed, looking at the economic situation, looking at how the banks are doing, there is a likely chance that Fed might not increase the interest rates. So what really happened here was, then this 0.5% went off the table. Right now, there is a 0% chance that the market is expecting that the Fed will do a 0.5% rate hike. Till yesterday, till day before, this number was 50-50, approximately 50% chance of no change and 50% chance of a 0.25% change. But then yesterday, we saw the European Central Bank, ECB, hiking the interest rates by 0.5%. And they said that even if we hike, we will provide liquidity if any banks need. And in Switzerland, the Switzerland Central Bank has provided liquidity to Credit Suisse. So then this went higher. Then people said that if ECB has done 0.5%, then there is a likely chance that Fed will also go with a 0.25% rate hike. So right now, the expectation of the market of a 0.25% rate hike is around 84%, and today is 17th March. And of a no change in interest rates, there is a chance now 15%. So market is mainly expecting that there will be a 0.25% chance that there will be a hike. 84% chance that there will be a hike of 0.25%. So we are likely to see that Fed will increase the next one by 0.25%. And if there is 0%, and if the probability remains like this, and by any chance Fed doesn't do any change, which I don't think will happen, but if that happens, that there is no change, then your stock market is going to rally pretty good, and there is a likely chance that in the short term the stock market will rally 3 to 4%. There is a likely chance, but I think Fed will stick to 0.25% in this meeting, which is going to happen on 22nd March. So this was what I wanted to share with you guys, and I hope you got a better understanding of how the US market is placed and what is happening in the US economy. To stay updated with more content like this, do subscribe to the channel firstly, and also do hit the like button, and I will see you in the upcoming videos.